There are many indicators you can look at to determine the current state of a particular stock, index, or asset in general, but looking at it from a top-down view or zooming out, as I refer to it, gives an alternate and perhaps a more complete assessment. Today, there is an absolute tidal wave of cash flowing into new startups with insane valuations attached to them based on some unicorn and Sasquatch mentality for some of these beasts. But I guess at this point, nobody really cares because the Fed will make sure that there aren't any problems. You came here for the truth, so let me unveil that for you. Today, we're going to talk about Yeti, Sasquatch, the leprechauns, and maybe a few unicorns too. That's really where we are today. I know it's a little laughable, it's a silly joke, but in a sense, it isn't. Let's go. This is an article out of the Wall Street Journal. You've got to take a look at this. Deal flow and valuations are reaching new heights in technology startups as a flood of cheap cash fuels efforts to find the industry's next big winners, from software to social media. They talk about things like Clubhouse. They talk about all these new apps that personally I never heard of before, but are suddenly becoming popular. It's not as if they have millions of people on their apps. That's one thing, but the valuations of these companies are absolutely in the stratosphere. In the first quarter this year, US startups raised $69 billion from investors, 41% more than the previous record set in the fourth quarter of 2018. The average valuation for startups at all stages also reached a new high, and more than tripled from last year to $1.6 billion for late stage companies. Quote, "I've never seen it this frenzied." I've never seen it this frenzied. And this particular individual started his investment fund, which gives investors access to purchase stocks in startups like in 1999. It's lightning fast rounds with a lot of cash. They talk about how fast it actually is. So check this part out. Investors are offering startups 5 times or more the amount of money that they're asking, and deals that used to take months now sometimes close in days. Startups are raising cash every few months rather than every couple years, and valuations are soaring with each new check. So this is very important to understand where the money is coming from. Now, there's nothing wrong with a successful company, or at least a company that is projected to have success, to have investors backing it, and that ultimately makes things run, because you may not be able to get that capital if your Clubhouse may not be able to go to JP Morgan or whatever and get that cash from there. You've got to get investors, you got to sell them on your idea, and you could have the millions and you could have the billions going your way. But when you understand what is underlying all of this, it is very frightening to realize that the Federal Reserve raising interest rates by just a small amount would make the entire system. We're talking about all of the funds that are surrounding, really relying on the cheap money, and all of the housing markets around the world that are ultimately waiting for the Federal Reserve to increase. And that's really what they're, looking at, because all the central banks happen to follow what the Fed does. And then you look at, in this case here with the startups and so on, it's one rate increase to start the fear happening. And we know that it is very, very possible that if inflation does pick up, they can only let it go so high before they do something. Because at one point, there's going to be, if inflation picks up in their statistics beyond, let's say, 3%, which is very possible, if it gets to that point, maybe it's going to be some who start to say, look at what you're doing, you've got to act. So we'll see what happens. Of course, for the time being, though, this bubble can continue to grow. couple more pieces of data related to Archegos, because of course this is connected with the whole issue I just spoke about a minute ago. Wall Street banks have long relied on a familiar system to limit the dangers of trading with big clients, assign sales staff to win deals, and risk controllers to keep them in check, even if it sacrifices some profit. At Credit Suisse, who was obviously very intertwined with Archegos recently, executives have given the point salesman to Archegos on its swaps desk the new responsibility instead of overseeing risk-taking in the broader prime brokerage unit. This year, Archegos swap bets spectacularly collapsed, and they had $4.7 billion of losses. Okay, they talk more about that, but there is something in the next one I want to show you. Big numbers here. Credit Suisse amassed more than $20 billion of exposure to investments related to Archegos. $20 billion. That's one bank. Now, perhaps this is the biggest exposure, but we're talking about one single bank who's supposed to be, wise, who's supposed to have investments all over the place. They're not an individual investor. This is a bank. They're supposed to be making the right choices, dealing with the right people, with the right countries, with the right corporations. But they've got $20 billion of exposure to this one company who was using maximum leverage, who was creating these derivatives out of thin air. And look what happened. So my question is, how many more companies are in this situation? Right now, you can see that leverage, both gross leverage and net leverage, is at the highest. We have seen it in at least, this chart showing us 2018. We are seeing the amount of leverage, the amount of margin, and all different types of extreme activity rising to record highs. In keeping with historical behavior, the rise in discretionary positioning has been in line with that in the ISMs. So looking at the purple line, which is the ISM manufacturing, then you've got discretionary investors positioning. And of course, because of the activities of the central banks, we are seeing the extreme, as we move through the cycles, at the top of the top of the top, and that continues to get pushed higher and higher. But of course, the problem is that the higher it goes, the further it eventually falls. There are no soft landings, and if we have learned anything from the last time we've had some major drawdowns, it's that they have been very aggressive. And that brings me to the Money GPS insight. I think that people, when they buy into a company like Apple and they're putting their money into the S&P 500 index fund, they're not understanding the underlying financial system and how it is all intertwined. So what do you do as the individual? Well, if you've got your money with one company, you're obviously taking a big risk, because we never know the underlying problems that they have. If you look at one of the issues with tech that ultimately has been ignored for so many years, is that there's regulation to worry about. Very, very low regulations on an industry that has been really threatened to be dealing with a lot more. So that's one problem there. If you look at oil and gas industry, obviously in high demand, but with all the movement towards the green and eco-friendly and this, you might have some long-term issues there, and so on. I'm making a point here, but where your money is at is obviously going to be impacted by the changes, and that is known in the current landscape. So I hope that is of some value. So whenever you put your money in, understand the implications of what is being happening today as well as that in the future. And this comes out in the news all the time. That's why you got to stay active and up to date. Used car prices leap on U.S. economic recovery and supply crunch. This is just one thing that I wanted to note here. Actually, they've been heading higher for a while. And I think part of that is that people are going back to work. Maybe they don't want to take the mass transit system. And so they're getting into the used cars. We could also see the price of the new cars going higher as you see many problems that people have been noting. The prices rising with all the components and so on. Here's the chart that corresponds. Secondhand soaring, an index of US used vehicles surged to a fresh record in April. This has been going up. Obviously, as you can see, the chart goes back to the year 2000. But since March 2020, this has been going sky high. Businesses plan to respond to cost pressures by raising prices. This is at almost a record high that we're seeing today. The chart goes back to 1987 up until the present. And clearly a lot of businesses, based on, it's hard to tell here, around 35% or so. So that's the ones that are willing to admit it. You can make assumptions of what the actual number would be. But the point is that many more businesses today are believing that they're going to have to increase their prices. And what does that mean? It means less money in your wallet. One example of that, and I've shown many before, Procter & Gamble will raise prices in September. Of course, they can hold off for a period of time. They didn't want to do so through 2020 and look real bad. So what are they doing right now? They're going to increase their prices. We're talking about everyday household items. And you could say, you know what? I'm not going to deal with Procter & Gamble anymore. So you got to look at the label, figure out, is this a Procter & Gamble company? But then it's going to be the next company. And then it's going to be the next one. And that's the way this works. Yes, the price of plywood is up in the range of 252% with market factors to blame. This is just showing you, I believe it's down here. Yes, you could see there was this post apparently that was talking about the prices have been rising. I know I have got the comments before talking about 2x4s and so on. I have told you that you should buy not 7 shares of Amazon, but 7 2x4s, and you would have made a heck of a lot of money. And that trend continues. Food for thought. 3/4 inch plywood standard. March 2020, it's about $38 a sheet. April 2021, it's about $96 a sheet. It is insane to see where the prices have gone. I've got several things to cover right here really quickly. Chipotle earnings smash estimates as online sales overtake in-person orders. People are getting more comfortable. The reason I show you this is because people are getting more comfortable with ordering online, with using their apps. They can either get that delivered to them or they simply walk into the store and pick it up. There's less human interaction. You know that robotics and automation are simply taking over. It is going to happen. I've shown you the burger flipping machines for about $30,000. They could make those burger flipping machines, put them in, I think it's called Flippy or something. They get that to happen. It can replace 2 workers. $30,000 to replace 2 workers seems like it's likely going to happen. So you can order from your app. You could walk into the store. There's probably 1 employee right now, and they'll probably get rid of that eventually. 1 employee working there, just making sure everything's all good. Your food has been prepared. It's been processed by the machines the whole way through this ordeal, and that's probably the way it's going to go. So as an investor, you should be aware of that. More automation, more robotics. I wanted to give you some updates right here on gold. On the left side, you could see that it is pushing towards 1800. 1800 has been really a resistance point for gold. On the right-hand side, we've got silver sitting at approximately, depending on when you watch this, at the time of this recording, 2650. And I pulled up the 1-year chart to show you that it has been trading within this range, $25 to let's say $27, at the most for the last little while here. And gold has been behaving a little bit differently. They do somewhat track each other, but you can see that the performance over the last year has been quite different from silver. But in the short term, at least, the more tension there is, the more concern there is, gold is obviously going to see that benefit first, and then silver usually follows and lags behind it. While it's not at the peak, Ethereum has moved up in price, that's for sure. This is over the last year or so, as you could see, but certainly since 2021, it has skyrocketed higher. And if you look at the ETH compared to Bitcoin, you're going to definitely see that Ethereum in the short term has been outperforming Bitcoin. Now, that doesn't mean for the long-term trend that it will, but certainly all eyes are on that ratio. The S&P, of course, on a tear. I just wanted to show you this looking over the period where it fell March 2020. It has basically come up in a straight line. I mean, you want to level your house out, you could check this out and use this as the line that you need to basically realize how unbelievably buoyant, if you want to use that word, the market has been. There has been absolutely no downward pressure since that point, thanks to the crutches provided by the Fed. Anytime there has been a little bit of downward pressure, the Federal Reserve will do one of their conferences, an interview, and they will push prices up higher. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you're supporting me. I want to thank you for that. If you want to learn about e-commerce, you can do that for free. You don't have to go and click on videos here or there. What am I doing? Am I doing Shopify? Am I doing drop shipping? Am I going to sell t-shirts? No. Check out the course. It's free. There's nothing to it except learning how this all works step by step. The AmazonGPS.com. If you want to understand the financial system from top to bottom and you want it explained extremely easily, you can do that right here in my 2 books. The link is in the description. Have you seen this video yet? Well, you gotta check it out. Click on it and I'll see you there.